Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Archer Daniels Midland stock, ticker ADM, not AMD, which I replied to a bunch of people the other day when I mixed it up in my head. As a bonus for me getting it completely wrong when I replied, I'm going to do this one right away. As always, this is not individual investing advice. This is just how I analyze stocks. I have covered ADM before, back in 2023. It felt like I had covered it earlier, so I wasn't in like a super hurry to do this video. But when I went back and looked, I actually did an update over on Patreon in 2024. So I think that's what I had in mind. I do have a free tier on Patreon. The link is down in the description. I post the same videos that I post on YouTube over on Patreon. That's a great place to follow for free. And then there's a $5 tier and a $25 weekly picks tier too. So if you watch my videos and you think I never buy anything, the weekly picks is a good spot to check out. Or if you just kind of want to ease in and see what I'm actually would be buying, that's a good place to start. And then the paid Patreon members can get a big discount if they ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. Okay, so I went back and watched part of my old video for ADM, and just to see if I said anything really stupid or if I was going to contradict anything in this video that I said in the past video. And much to my, I wouldn't say delight, but I was glad to see that I was pretty on target, I think, for what we knew at the time back then. And the long and the short of it is, let me shorten this time frame on the fast graph. So I was doing that video right around this period. We hadn't gotten the earnings in yet for 2023. And I assumed that the market would be correct. They missed these earnings. The earnings for 2024 are going to be like half of what they were expected a year ago. So that's one of the reasons why the stock is down. And I didn't try to make a prediction, but what I was trying to show is that this is kind of a recession setup. I pointed out the peak PE here was similar to what it was before the Great Recession, and that during that time it sold off to like a 5 PE, right? So it looked kind of cheap back here with a 10 PE, but historically the market, that didn't really matter for the stock price if there was a recession-like scenario. And then earnings kind of struggled for like a decade after that. So we kind of had a similar setup. So the idea was to be cautious. And I shared a recession buy price because this is kind of a recession setup. And maybe we are in a goods recession, right? Which is what these guys are in. And you can sort of draw similarities in terms of the behavior of earnings and maybe the behavior of the stock price, right? So that's what I was trying to talk about. I gave a recession buy price of just under $40 a share back then. So we're at 46 now. And so I can see why everybody's asking me about it, because it's pretty close to that buy price. I didn't remember what I had done back then. Now, since then, in the full Cyclical Investors Club in the spreadsheet, I've removed the buy price, but things aren't totally horrible for them. Earnings growth has just gotten a little too slow for me. Right now, I estimate the earnings growth. I'm going to say I was probably using a time period to estimate that, because I updated it in January. Probably running from like 2015 through 2025, maybe 2016 through 20, and kind of taken, if we took this whole period together and formed a CAGR out of their earnings growth, what would it look like? Occasionally I make adjustments for tax cuts, like 2018, so that big bump might have been mostly from tax cuts, and then I would include this decline. So when you kind of put all that together, they really haven't had, and I would have adjusted for any stock buybacks. I don't remember if they had a bunch of them or not, but I would have adjusted for all that and only gotten 3% earnings growth when it was all said and done. In between 3 and 4%. We'll look at that in a minute. So the question is, which is maybe a little better than inflation during this whole time period. Maybe not, maybe about the same. So they don't really have a lot of long-term growth. And if we go back to, I haven't looked at this, but I'm just going to take a peek at it now. Let's say we go back to going into the Great Recession. We'll leave one growth year in there. And then we kind of go to this year. If we just go point to point, you can see, even not including these drawdowns here, although this wouldn't also include this bump. So they kind of offset each other. That earnings growth range is pretty much what I'm saying. Like I'm saying I'm more optimistic, a little over 3%. And right now, I really only want to buy companies where I think earnings growth is going to be 5 or better. So that's why I don't have a buy price on it. But what I want to do is, because people can totally disagree with me, and I don't know what their earnings are going to do going forward. I try to use the past as a guide. Analysts are looking at, flat, basically. But sometimes when you have 2 years where they fall like this, analysts can get kind of pessimistic. Like that's when they start to overdo things. So it's totally possible. And where's the stock now? 46, and it was 46 going into the pandemic. So we've round tripped back to where we were stock price wise before the pandemic. And so I think it is worth looking at the optimistic point of view, or however, I'm going to use realistic earnings growth, but where that's kind of the baseline. And then maybe if something good happens, you can make like a decent amount of money. So instead of using the recession PE, because we've already had earnings fall now, and I'm going to look forward, so I'm going to assume there's like 3 years of earnings decline back to kind of somewhat normal, non-COVID and stimulus boosted earnings. I'm going to use a time until payback, earnings time until payback method from here. So I'll say, okay, let's say this is the bottom, and they can grow earnings 3 or 4%. What does that payback time look like for an investor buying around today's price? So I've been making a lot of these videos. I plan on making more because it's easier for me to explain this than things like the recession PE. But we can see that when I used that in the past video, a year and a half ago, it would have kept an investor from losing, I want to say that came out in October, whatever this decline was, almost a 40% decline. Even though things didn't look like it's a 10 PE, they had all this growth a couple years before. Understanding kind of these earnings dynamics and what can happen and what the market can do to a stock by looking at the previous declines as a guide can help you avoid some of these. Now, I'm not any more perfect. I'm definitely not perfect. I have stocks that are down a lot, but I try to avoid the ones that I can place a higher probability that they have a lot more to fall, especially when the reward isn't probably going to be great. So there wasn't a lot of reward compared to the risk there. All right, so I adjusted the stock price up by about 25%. So when I look on the fast graph, they don't have the total enterprise value here, but they do have the long-term debt to capital at 25%. So I'm assuming you're buying that long-term debt along with the stock. And so I'm adjusting the stock price up by 25% to $56.85 a share for valuation purposes. So if you were a person buying the whole business, paying off the debt, what you have left for earnings is kind of how I'm thinking about it. And so what I want to know is if you bought it for $100, how long would it take to earn $100 in earnings proportionately, to how much you bought. So the good news is, even with that adjustment, the earnings yield is a whopping 7.79%, which is really good. That's really high compared to most stocks in the market, and you'll see that reflected in the PE ratio, right? Even if we added, let's see, because we don't have too big of a drop coming. I'm looking forward to these lower earnings too, so I'm pulling forward a little negativity. Even if we look at that, so we have like let's call it a 10 PE. If we add 25% to that, you're looking at like a 12.5 PE. So that's still pretty good. 12.5 PE is a good earnings yield because the PE and the earnings yield are the same thing. They're just inverted. So, but the problem or the challenge is this is only expected to grow at 3.12% per year. So you start off with a high base. On your $100, you're going to earn almost $8 back the first year. But that amount is going to grow at a pretty slow rate. So if we take a look at it in the spreadsheet here, yeah, the first year you would, if you pull forward that earnings growth too, you earn $8.04 on your $100. The next year you earn $8.29, then $8.54. So you start with a higher base because you're not paying that much for earnings, but the expectation for the earnings growth is pretty low. Okay, so when you do that, it's going to take about 11 years before you earn your $100 back from the earnings with those assumptions. 10 years is about what I like to see. And if we type in the $40 a share that was my recession buy price previously, we get the 10. So we're pretty close there. And sometimes, it's not about like telling people like what to invest in or what's a great price. It's just kind of narrowing down all the factors to like what's the most important thing. And then those usually the last one or two things the individual investor needs to make a judgment about. So in this case, the judgment is if you think that these guys' earnings have probably close to bottomed, and you think they can grow earnings at 3 to 4%, then it's getting pretty close to being a decent buy here relative to the other things that are in the market. Now, if you think there's a bias that maybe they'll get some growth beyond this, that's when you make real money. If they grew earnings at 9% for the next 3 years or something, you got probably a 50% gain in the stock. If the market decides it likes it, you never really know. On the other hand, the trajectory right now for earnings is down. Let's say, we have going into 2020. Well, in 2018, earnings were $3.50 a share. They were $2.63 going into COVID. I would say that $3.50 is probably a good mark. We have had some kind of sticky inflation for sure. So let's say that $3.50 a share that would probably be my bias kind of for what earnings are going to kind of maybe bottom at. But I don't really know. So, but I wouldn't be more negative than that necessarily, right? So the market's getting pretty negative. I think these expectations are getting more realistic now. $3.50 a share-ish is kind of where, a potential bottom might reasonably be in terms of like probabilities. And so, yeah, things are getting interesting now. So what happens is if they can get to that level and then find some growth for like 2 years in a row, maybe 3 years, that's when you could potentially make some decent money in the stock. And it's because growth is so low, that's when I would probably take profits if I did buy it. Even though I don't have a buy price right now, I mean, the downside risk at some point is not super high. So you start thinking, okay, if things go my way, I can make 50% in 3 years. That's a worthy investment. If the downside gets to the point where it's only like 20%, even if things are kind of crummy, okay, now you have 20% downside potential, 50% upside potential over the medium term. That's when it's decent to make like an investment, I think. That's how I think about it anyway. And we're at least down in that range where if a person did a little bit more work and they had some views on what the macro is going to look like and things like that, then they could legitimately start, considering buying down around the $40 level, I think. We're not quite there yet enough for me, but yeah, it definitely looks more interesting, right? And as a long-term hold, let's just look at what it's done. I'm not going to cherry pick any dates. I'm just going all the way back to pretty much the beginning through now. Long-term, they got a 7% return in probably a 3% inflation environment, annual return. So that's not bad. I mean, I would say that's like, well, now we have a lot of tech. If you mark off tech and push them in their own category, then that's okay. Like that's an okay return long-term. So, it's interesting. All right, I hope that was useful. I'm not you know, at least hopefully I framed things up for everybody. If you did find it useful, hit the like and subscribe button. If you have a request of your own, put it down in the comment section and I will get it on the chalkboard behind me. A lot of those are getting crossed off of the chalkboard right now. I'm working my way through pretty fast. But I will respond when I get it actually written down so I don't forget it. Okay, thanks for watching. I'll see everybody later.